Hey, welcome to the Mortgage Minute. I know what you're thinking before you get started. You're thinking, oh my goodness, here's another RSP blog. Someone else going to be yelling and screaming at us about investing in RSPs. Well, kinda. Yeah, because it's that time of year. It's the RSP deadline is coming up at the end of the month. More important than anything, though, is I want you to start to analyze a couple of things. First of all, where are you sitting at in terms of your pension and your retirement? You know, for a lot of my clients, if you invest in real estate, you might think, you know what, my real estate does what I think it's going to do. I'm going to be earning more money in retirement than I do when I'm working, so I don't want to be investing in RSPs. The whole idea of RSPs is tax deferred. That's a whole other topic. Bottom line, if you are putting money into RSPs, start to analyze what kind of returns and where you're allocating it. Here's an interesting article talking about even top earners, maybe and for a shock. It talks about retirement shock because they're saying lifestyle creep can lead to a rude awakening, and a lot of people are not prepared. They're either not putting enough money aside, or the amount of money they are putting aside is not necessarily going to be enough. Now, here's the big thing. Since the Trump election, we know the stock market's been going up in a virtual straight line. But we also know that straight lines can't last forever. So there's a whole sentiment of when is this market going to correct? It's like the Vancouver housing market. Everybody feels that inevitably, it's inevitable that we will have a leveling off and a bit of a correction. Well, the same is true in the stock market. So a lot of people are taking what they call a defensive tactic. Now, I want to look at that defensive tactic. What does that mean? For some people, that means moving into real estate. For some people, that means moving into gold, precious metals, and things like that. But you know, the other thing that I want to look at is where's the smart money going? And this is a great article. Thane Stenner had an article. What can we learn by watching smart money move? And I found this particularly interesting. It's even important enough for me to put my glasses on. I don't need these. It's just a prop. It really just shows the Tiger 21 members. This is 21 of the most wealthiest individuals. The Tiger 21 group. Number one asset allocation is real estate, 30%. Next is public equities. That means the stock market, public market, 21%. But guess what number three is? Number three is private equity. It's not just all your eggs in one basket. It's real estate, public markets, and private equity. 1, 2, 3. And that makes it really interesting because I think the whole concept of this private equity, which a lot of people are not familiar with, an area that I work with, TriView Capital, as you know, we do a lot of private equity. And everybody's like, well, what are you saying? We should put all the money in private equity? No. What I'm suggesting is you should follow what groups like Tiger 21 are suggesting. And here's another article saying a worthy alternative to bonds, private debt. Here's an article that says, it goes on to talk about a variety of different private debt, but most importantly, putting your money into private mortgages rather than just simply putting it into debt. Listen, what's going to happen here in the upcoming weeks as we approach the deadline for the RSP deadline, people are going to flock, Canadians will flock to their banks and simply, like in a robotic fashion, put billions of dollars into ETFs, mutual funds, stocks, and bonds. Now, I'm not saying any of those are right or wrong. I'm just saying that a lot of people are over allocated. You know, and when you look at it, most people just don't understand that they do have alternatives. I'm going to give you, I think this is a very powerful article. And by the way, if you want to copy this article, send me an email and I'll send this to you. It was Frontier Gotex. This is an article that said investing, sorry, I'll read it correctly, investing like Harvard and Yale endowment funds. Now, the Harvard and Yale endowment funds are considered to be some of the most successful pension funds out there, period. But listen to this. I'm just going to skip to the summary. It says the super endowment funds, which is how they refer to Harvard and Yale. The super endowment funds of Harvard and Yale have consistently achieved attractive investment returns with moderate volatility due to their multi-asset approach to investing, the strategic approach to asset allocation, and their significant exposure to alternative assets. In other words, they invest in not just public markets, but also hard assets like real estate and private equity. So last but not least, I just want to wrap up by saying my whole point to this RSP rant, if you will, is now is the time, more so than ever before, for you to have a defensive approach. And by defensive, it means proper distribution and rebalancing, not just putting everything all towards the stock market, which we know eventually has to have some correction and adjustment. So the best way to diversify is to diversify in asset classes like the Harvard and Yale endowment funds. So last but not least, facing dilemma, should I pay down my mortgage or top up my RSP? That's a great segue to say, you know, in every instance, for every one of you, it depends. Each of you have an individual and personal situation and requires a consultation. That's what I'm offering you. Give me a call. If you're wondering what to do in this RSP season, please reach out. Happy to offer you a free half-hour consultation so we can analyze where you are, where you're going, and what's the best plan to get there. That's the Mortgage Minute for this week. Hope you have a fantastic February. Thanks.